Good morning, class. In this short video tutorial, we'll be going over the owner's equity accounts as they relate to a corporation versus a sole proprietorship. In the past, owner's equity in this sole proprietorship, we had the owner's capital, and the things that affected owner's capital were contributions. They were added, the normal balance as a credit. They were added, withdrawals were subtracted. They decrease owner's equity, contributions increase owner's equity, net income, profit increases owner's equity, and net loss decreases owner's equity. So here's the T accounts that go along with it. So owner's withdrawal is a contra account. We close that up into owner's equity. Revenues increase owner's equity, so they have the same normal balance. Expenses decrease owner's equity, so it's a contra account. And we used to close out the revenues and expenses to income summary. And then we would close out at the end of the period income summary up to owner's capital, and we would close out the other temporary account, which would be the withdrawals, up to owner's capital. So this was the structure for owner's equity in the past. But now we're using corporations. Okay? And the corporate equity section is a bit different. The owner's equity section is a stock. Okay, so we have common stock. Notice the same normal balance. Paid in capital in excess of par common stock. So we issue common stock usually at par or stated value. That par or stated value is an arbitrary amount, just so we can figure, we issue at par because we can figure out how many shares we have issued by dividing the total amount in common stock, the balance in the credit balance, by the par will tell us how many shares are issued. And we need to know that for when we do, if we disperse dividends. So we'll be issuing at common stock at par, in excess of par. So if we sold it for more than our par value, then the excess amount would come into this account here. And this will be our total paid in capital. We also have preferred stock. Okay, preferred stock receive dividends before common stock. Not all companies have preferred stock. It's more like a bond or a loan than it is a stock, in that it has a guaranteed amount of dividends that they receive by the percentage, and it goes away after a number of years. So it has a different attraction than common stock, and it's paid in it as preferred, so they get paid capital first. Whatever's left goes to common stock holders. And we'll see here that we have retained earnings. So this is for paid in capital. So when owners pay in capital, they buy stock, similar to here. It's like contributions. Retained earnings are the net income. Net income under income summary used to get closed up to capital. Now we close up net income, revenues, and expenses up to retained earnings. And this is a separate account, and it holds earnings that net income or net loss, the totals from the past. Then we have some temporary accounts. Cash dividends. Okay, cash dividends is a temporary account which closes to retained earnings at the end, but it's similar to owner's withdrawal. Okay, owner's withdrawal, they would withdraw money out of the company for their own personal use. Here we have dividends. If dividends are declared, we'll declare a cash dividend here, and it'll be paid out to between the preferred and common stockholders. So this is similar to withdrawals. It's how owners take money out of the company, but the company has to declare the dividend. Also, we have treasury stock. Treasury stock at cost is common stock that we buy back from the open market. Sometimes we buy back the stock because we believe it's undervalued. So it shows a notice to the investing public that we're buying back our stock, which usually stimulates the market because they realize that we believe that the stock is undervalued. So it may trigger the sale of more common stock or the raise of price, market price for common stock. And we issue common stock back, treasury stock back out to, usually in stock options, to preferred employees, CEOs, CFOs, high-level management, as sort of like a bonus. So we issued out to them at a preferred price, usually a lot lower than the market price. So we tend to use that. When we do that, we tend to use treasury stock to fund that. So we'll buy and sell treasury stock back and forth, and we buy it at cost and we sell it at cost. So again, we have another account. These are contra accounts, they're boxed. We have another account, paid in capital from the sale of treasury stock. So this would be when we sell it. If we sell it at a premium, it would be it would have a normal balance here. When we sell it at a discount, we'll be debiting it. At the end, if the sale of treasury stock at a discount, if there is a deficit in the paid in capital from sale of treasury stock, the balance would come out of retained earnings. So in other words, if we sold it back out for less money than what we paid for it as a total, then the money, the balance, the deficit would come out of retained earnings. Would come out of retained earnings. So it would balance out. This is just a brief tutorial on this, which will help us later when I'm going over the PowerPoint demonstration. But this is a good indication of what the stock normal balances are, what the T accounts look like, and could help you, if you print this out, could help you with your homework.